Thank you so much for joining us for 21 loans and credit lines that you can get with your business startup. There's so many loans out there, and a lot of times when you're trying to first start out your business and you're not quite sure where to start, the first thing that you want to do is really make sure that your business has a very firm foundation and all your fundability factors are in shape. What I mean by that is, say, for instance, you start out working in your house, and so you have your home address, some of the official documents, and then you go out and you get a commercial location, you get a bank account and things like that. Now you have a commercial location. So when a computer goes out to check documents, you might have one that has a home address and one that has a work address. That's what fundability factors are when you're trying to get loans. And most of the time I found in my career, and I've been doing loans now for about 20 years. And the number one reason that most people these days get turned down is the computer actually turns you down. It's not actually a person looking at your application. So if it has two separate addresses, the computer thinks that might be some fraud involved. And so it'll turn down that application. Where if you can just get those addresses where they are both correct, then the computer will approve it and you'll get that automated approval, which is what everybody really wants. And so that's where we are currently. And so today I just thought we would go over some ways that you can reach out and you will be able to get loans for starting and funding your startup. So let's take a look at that. And if you'll take a look at my screen, you'll see that conventional banks are not a good place to look for startup loans. A lot of times you have to have one of the three C's, either credit, collateral, or inventory. And so what they're looking for is something where they know that if they loan you that money, if you don't pay, they'll be able to somehow get their money back. And that's kind of the mentality that commercial banks have. Usually they'll want 2 to 3 years of tax returns before they'll lend you any money. And again, this is a lot like when you're doing a mortgage loan. So if you think of a mortgage loan on steroids, everything that you would normally need for a mortgage loan, you would need at your bank. In addition to that, you would need, in addition to your personal information, you'd need the same information, but on your business. They're going to want to look at 2 to 3 years of your tax returns. They're going to want to look at your last 3 to 4 months bank statements and things like that. And if you're lucky, they may give you a credit card. But about 89% of business applications are denied by the banks. And again, the computer's what's denying those. And again, if the fundability factors are, and that's how your business is set up, and also how you've applied for loans in the past, because they actually scan a copy of your application. So every time you do a new application, they'll compare it to one of your previous business applications. So it's really important to always use the correct information when applying for conventional loans. SBA loans are also a little tougher to qualify for because the lender in the SBA will evaluate all aspects of the business and the business owner for approval. And so what that means is the SBA is going to look at, you're going to have your local bank, and then you also have the SBA, because the SBA is going to be pretty much saying that we're going to guarantee that loan. If that company goes bad, the US government's going to stand behind that loan and make that loan good for a certain percentage to that bank. So they're going to want to take a look at that application as well. And that's one of the reasons that SBA funding does take a little bit longer to do. but it is very doable. It's just a matter of, again, making sure that you have all the necessary documents for your corporation and make sure that everything matches up. So when the fraud detection software goes to work, it's not going to go off because there's separate addresses or different phone numbers or different email addresses. So all that's super, super important. Um, and try to stay away from cash flow financing too. Um, they want you in business for at least a year, and they want to see $10,000 in monthly deposits. Cash flow financing, if you're not familiar with that, that's when you have, say you have credit card receipts and your credit card receipts are, say, $20,000 a month. Well, they'll advance you a portion of that money that's coming in. And so you can get financing that way, as well as now there's lenders that will actually just hook up to your bank's to your banking system, and they will then the computer takes a look at the deposits and the withdrawals in that business over a period of time, and the AI will actually make a lending decision in that case. So it's something that's pretty good. Private investors can be problematic too. And that's just because they want 2 to 3 years of tax returns before they'll loan you any money. Again, a lot of people on this call are people that are startups, so you don't have any tax returns. So the first several of these might not be so good for you. Because if you don't have the tax returns, you don't have that business history. What they can go by is they will look at how much your personal income is, and if your personal income could support that business loan, then a lot of times you can get approved that way as well. But it is much more difficult to do. Venture capital is also not a good option unless you have like a really good software product or something that's very unique and something that people are going to want to take a look at and say, man, that is something I definitely want to get behind and put their money. But they're going to want to see where they put their money in, the business grows, goes public, and then they get their money back out. And they're also going to want a chunk of the ownership of your business. And a lot of times people are looking more for loans and not so much for sharing ownership of the business. Um, uh, quite quite frankly, a lot of times the reason people are in business for themselves is because they don't want to work for somebody else. And so that probably wouldn't be the best situation there. Unsecured financing can provide some of the highest loan amounts for startups. You can get 0% on business credit cards, and it's stated income. There's no financials required, and these report to the business reporting agencies. And that's so important because when you're creating your new business credit, you want to make sure that they're reporting to the business credit reporting agencies. That's something that's super important. And you can build credit at the same time. So it's something that's kind of neat because we have kind of a hybrid loan that people can get up to $150,000 in combination. And it allows them to be able to start up, do their cash advance, do whatever they need to do to get the money in order to fund their business. But it's a great way for people to get going if you don't have the financial stability to support a bank-backed loan. You can usually get a loan of 5 times the amount of your highest revolving credit line now. And so the great thing about business financing is they usually 5 times it. So if you had a credit card of say $500 that was open, and then the next card that they're gonna that they'll approve you for will probably be about 2,500. They 5 times it usually, and this is up to 150,000. And this is the highest amount of financing you'll typically see for a startup. In a startup, what I kind of, when you're trying to think of what do you classify a startup? I consider a startup in 0 to 2 years, because especially during that first year, it's just so crucial. And then the time right before you actually open and decide to go uh, out to the public and present yourself, it's so important to have all your fundability factors taken care of. And we'll be covering that in a future video as well. And the highest, and you can get cash out on the program. The unsecured financing, they're going to look for a higher credit score. Usually you're going to need around a 680, 700. There's going to be no impact usually to your personal credit for this type of financing. And it's super important to remember that when you have business credit versus personal credit, it's so much better to have that business credit, because then it doesn't affect your personal credit score. So say, for instance, the business has $250,000 loan out. And if that was in the business name only, then it would just affect your business and that in the business credit. So for instance, if the business went bankrupt, it wouldn't affect your personal credit. And that really helps when you go to buy a house and stuff like that, because so many business owners are trying to open their business and run their business with their personal credit. And so when you do that, it really hinders the growth of your business, because it hinders the amount of financing that's available. In commercial financing, you'll see that you have a lot of different options as far as different types of loans and different types of financing that's available to you. With good business credit, you can get unsecured credit cards without a personal guarantee that are going to be actually in the business name. And the approval amounts are going to vary from 10 to up to 150,000. There's no consumer reporting, but there is some business reporting. So business cards will report to the business credit reporting agencies only, usually, unless you did a personal guarantee. And personal credit cards only report to your personal to the personal credit report. So you want to make sure that you know that there's a difference, and you want to make sure that when you do apply or you're making payments, that anything that's for the business, you try to make that where it's in the business EIN, which is the employer identification number, and instead of your social security number, and that everything's separated between personal and business. Excellent personal credit with open revolving credit. They're going to look for low inquiries, and approval amounts are equal to your current limits. So if you'll look at what your current limits are for unsecured credit cards with good personal credit, these are great for people that if you have great credit and you want to get into business, you can get up to $150,000 this way. And it's a great way that people can fund their business right at the beginning in the business name without affecting their personal Social Security. And then the APR is 0 to 25%, 0% for 6 to 18 months. And there is a 9% success fee that they do charge if you want somebody to help get that place for you. Approval amounts, again, they report to the credit reporting agencies. It takes 6 months to build a good credit profile. At the end of 6 months in our coaching program, you'll have about 12 different lines of credit, and you'll have an excellent credit profile. And that's what you want. Personal credit is not used. They only use that for pre-qualification. Approval amounts are equal to your current credit limits. And there are a lot of loans a startup can get, and they're usually not coming from the bank. And let me give you some different ones that you might have. And this is where you might want to just keep out your notebook, and you can write down some ideas. And what I always tell everybody is this is kind of like a toolbox. Take the things that take out the tool that'll help you. And if there's something that doesn't pertain to your business, or if you've already set that part of your business up, then no worries, just keep on trucking. And so then you have equipment financing and leasing, and you can use that to buy your available new equipment. If you're a real estate agent, you can use that to purchase vehicles. If you're a welder and you need to buy welding equipment, then you can get equipment financing and lease the equipment that you have. And they have some excellent leasing programs right now, especially on welding equipment, because I just recently priced that out for a client. And they were able to lease it. And then at the end of the lease, they were able to get it to actually purchase it for a very low amount, or they could get all new equipment at the end of that lease period. So it really gave them some really great options of what they can do. You can also put up commercial signs. You can even get loans to get graphic wraps for your vehicles. So just about anything that you have that's out there, instead of saying, I need to go to the SBA because I need $100,000, you can take all the money that you need for your startup. Like, let's say you have commercial equipment, you have advertising, you have signs, you have office supplies, you have all the different areas that you're going to need products in. And you can look at that list, and many of the things on there you can go to and get store credit, like at Office Depot for your office supplies. And so then it immediately gives you $10,000 worth of credit right there. So now instead of needing 100,000, you only need 90,000. Then let's say you had $40,000 worth of equipment that you were going to get. Now we can get a loan just for the equipment financing. And now you have that 40,000 plus you have that other 10 from Office Depot. So now you have 50,000. So now you're halfway there. As you can see, there's a lot of different ways that you can put together a loan package for your startup, where it's not just going into the bank asking for the bulk amount. You get different store credit in different ways that you can build up the different pieces of credit to get you to where you want to go. You can always use your assets as collateral. Say, for instance, you've bought equipment already that you own free and clear. You can always use that as collateral to be able to get a loan. Those rates are 5% or less, and your personal credit rating doesn't matter, which a lot of people really, really like, because with the personal credit, that doesn't matter. It just makes it where it's just so much easier. Types of collateral you can use, a lot of people don't realize, but you can use your 401k. A lot of times somebody will be thinking that you're going to cash out your 401k and use that to start your business. It's much better if you get a loan against your 401k, because then you don't have to pay that big termination fee and stuff like that against your 401k. Or if a relative was going to be giving you some money to be able to fund your business, and they were getting that money from their 401k, again, you could just do that where it would be a loan against it. You can do a loan against your stocks. You can do a loan against existing inventory and accounts receivable. A lot of times people will bill people for their services. Like, let's say you go out and you do service for people today, and you then invoice them this evening, and they have 30 days to pay that invoice. Well, let's say you have a whole lot of invoices every month. And so instead of having to wait 30 days and you want to get that money right away, it might be $50,000, $60,000, $70,000. You've been waiting those 30 days. Well, why not have another company come in and either purchase those receivables or use them as collateral. And so it's just a much, much better situation. Or you can ask a friend or family member who has these kind of like I was just saying about a 401k. Because again, when you're doing a business, you can always have a friend or family member come in as an investor, and they can use their assets and they can use that as a leverage for a percentage of your business. So say, for instance, they had an asset and they said, yeah, my mom has this big piece of land. And so instead of her just loaning me some money, we could just do a loan and use that land as collateral for the loan. And then you could give them a percentage of your business for doing that. And then a venture capital firm, you could do that as well. 401k financing is typical. And with 401k financing, use existing 401ks or an IRA as collateral for the business financing. And it's you pay no penalties. You can still earn interest on your 401k. And where this is really good is, say you're invested in your 401k and you're making 12% or 11% or whatever you're making on your investments. Now you can get a loan, say this loan is at 5%, and you're still making a profit, where if you had to cash out that 401k, you would no longer be making that 11%. And so then you would just give that cash and you would have to pay a penalty to the IRS. In this case, when you get a loan, you would have the rate at 5% or less. So your investment's making 11% and you're paying 5%. So you're still good there. And you don't have to pay any early withdrawal penalties, which is really nice. And you can close and fund this loan in less than 3 weeks. So if you know somebody that has a 401k and they said, hey, you can use my 401k as collateral. I've had it for 20 years. But I don't want to take any money out of it, and they don't want to actually invest any money into your business, but they'll allow you to use their collateral. That'll allow you to be able to get a loan. In exchange, you can give them a percentage of your business because they would be an investor investing in your business. The amount of that loan or the financing proceeds that you would get back. Okay, they can do up to 200% financing. So whatever your 401k is, it looks like they can do up to 200% of that. And then the steps: a new corporation is formed, a retirement plan is created, which allows for investments into the corporation. Funds are rolled over into the new plan. The new plan purchases stock in the corporation and holds it. And the corporation becomes debt-free and cash-rich. So do you see how that happens? Is the way the 401k financing happens is they do a new corporation and a retirement plan is created, which allows for investment into the corporation, and funds are rolled over into the new plan. And the new plan purchases the stock in the corporation and then holds it. So, and then with securities, you use existing stock as leverage to get the business financing. Same thing, except for instead of using 401k, you're using stocks. You can borrow as much as 90% of the value of your stocks. You can continue to earn interest on the stocks pledged as collateral. So because the stocks, you'll still have them and they'll still be invested. And so wherever they're invested, they'll still be making whatever your return is on that. And then closing and funding takes less than 3 weeks. And then they're, again, 70 to 90% of the value, rates as low as 1.6. It's a working capital line of credit. And it's great for somebody with challenged personal credit, because again, they're looking at the security of the stocks or your 401k or whatever that you're pledging as an asset to to go back to. If you don't make the payments and they're having trouble getting their money, then they would then go back and try to recover that from the asset that was pledged. Accounts receivable financing. You can use your accounts receivable for financing, which is kind of what I was talking about just a moment ago, is when you take your existing invoices and people that owe you money, and instead of you waiting 30, 60, 90 days, or maybe never trying to collect, they will actually give you financing based on your receivables, and they'll go up to as much as 80%, and you can get that usually within 24 hours. So it's a very quick loan and very easy to do. Remainders of the accounts receivable is released once the invoice is paid in full. So what they're going to do is they're going to say the invoice was $100. They're going to advance you 80% now, and then they'll give you the remainder once that customer pays the invoice in 30 days or 60 days or whatever that might be. Closing takes 2 weeks or less. The factors rate as low as 1.33%. So what they do is they're going to charge you a charge of whatever that amount is. Like, let's say it was $100 and they're charging 1.33%. So on $100, they charge you $1.33 would be what they would charge you in order for that to do the service for them. And then accounts receivable credit line with less than 1% with no consumer credit requirement. Receivable should be within the government or another business. If you have purchase orders, you can financing to have those filled too. So even if, because some businesses, you write the purchase order, and so you're waiting for it to do, well, you can get funding on purchase orders as well. So if you're a business or you're just starting a business, like I just recently had a welder that is coming, and he has all these customers and he has all these purchase orders, and he's like, oh my gosh, if I could just get this equipment, we can then be much more successful, and I can hire these people and do this. So we were able to be successful in getting them a loan just because you're able to show that you have the business, and then people are always willing to loan you the money if they see that you are successful and you are going to have that cash flow. And so the great thing about this is, and about all these loans, is because then you're not actually using your money. And that's kind of the key of Walmart. Walmart borrows all the money for all the stuff in all their stores, and they hold on to their cash. And so what they do is they go out and they buy the stuff on credit. The inventory comes into their store. The customer then buys that inventory. And when that customer buys inventory, then they would then pay off what they would owe on that particular loan. So if you look, how much did it actually cost Walmart? It would only cost Walmart the cost of the actual credit, or the carrying costs that they would have had to pay in order to get that loan, but they wouldn't actually use their own cash in order to do that. So it allows companies to grow very, very quickly, and for you to be a lot more successful, because you don't actually have to have the cash to go out and do whatever it is that you do. You can actually have that all on credit, where that, and then when your customers pay you, then you just pay off that credit and the difference would be your profit. Get forwarded up to 80% of the receivables. You have to be in business for a year. These must be receivables from another business. And the rates are 1.25% to 5%. And again, what they're meaning there is this is made for, like, if you have a purchase order from me to another business, not from me to an individual. So they're really looking for commercial businesses that owe you money. So just your regular customers that you would have. Inventory financing. You can use you can use your existing inventory as collateral for your business financing. You need at least $500,000 in inventory, and you can get a line of credit for 50% of your inventory value. So if you just think about whatever your inventory is, just know that you can get, if your inventory was valued at 500,000, we could get you a loan for 250,000. And the rates are currently are between 5 and 15%, depending on the type of inventory that you have. The funding on this is 3 weeks or less. Inventory financing. The minimum inventory loan amount is 150,000. General loan to value is usually 50%, which again, it's the exact same as the equipment financing. They'll usually advance you 50% of what your inventory is. So say you have 500,000 in inventory, they could give you a line of credit of 250,000. So inventory would have to be 300,000 plus. It can't be lumped together inventory like office equipment. But just get with us. And again, these are just the overview, the, like you're doing Google Earth flying over. On all these, you're going to want to get with a loan officer, and the loan officer can go over all the individual program parameters and specifications. So feel free to get a hold of us. It's alexabusinesscoach.com. And we would be more than happy to set up an individualized consultation with just us. And equipment financing, you can buy or lease new or used equipment. Use your last month's payment. Rates vary depending on risk, and you can be approved with an average credit of 650. Now, when you're buying or leasing new equipment, they're going to be looking for a little bit better personal credit on that. And again, if you don't have it, but you have an investor that does, then that investor can stand in for that as well. And this is on major equipment, and the lender won't combine a lot of small equipment. Usually this is going to be, your big welding equipment. If you bought vehicles, major equipment that you're going to have kind of like is in that little thing. And they'll go up to $2 million. So a lot of times equipment financing, especially if you have a lot of expensive equipment that you've paid for or that's been paid for, this is a great way for you to go out and get a loan, and they fund pretty quick. And then another way that you can do is to sell your equipment, and then we have companies that will actually buy the equipment from you and then lease it back to you. And again, just get with us if this sounds like something that might be a good fit for you, and we will point you in the right direction. And you're selling the equipment to a lender for cash, and then they lease it back to you. If you need a larger piece of higher value of equipment to qualify. And so what a lot of times people will do is if they have something that's paid for, and now all of a sudden you have an opportunity to expand or to do a business opportunity that you need some cash for, and you want to get it really quick, you can do either the sale leaseback, or you can just do where they loan you money against it. So you have all different kinds of ways that you can go as far as equipment and inventory loans, and fundings in as little as 3 weeks. Investors looking to buy and flip properties who also have cash, experience, and average credit can get financing. And you can get financing against commercial real estate. A lot of times people don't know that you can get great loans against commercial real estate. So instead of you going into a building and leasing one office in this building, you could go in, purchase the building, lease out all the offices, and then your office is completely paid for. So there's lots of different ways that you can get commercial property that will give you a benefit both by appreciating in value and also from the depreciation that you can get on the property and the plant. Um, so that's another one. Insurance agents can get book of business financing, and that's just where if you have all these renewals coming up and you know exactly how much they are, we can get you in advance based on this. And this credit is linked to the EIN and not the Social Security number. And that's a huge difference because if you're doing stuff with your Social Security number, it's not reporting it to the business credit reports. When you do an EIN and you do a business credit application and a business, actual credit card, and it's not like a personal card that you're just using, you'll find that this is just a much, much better way for you to go. And so you'll really enjoy that. And this credit is available without a personal guarantee. It's available regardless of personal credit. You can get business credit immediately, even as a startup, and anyone can pull your business credit reports. A lot of times people don't realize that anybody can go. I can go in right now. I can pull Walmart. I can pull Google. You can pull a report on any business in the United States. All you do is simply go in to Dun & Bradstreet, put in the business's name, and they will sell you all the information that you want to know on that particular business. And you need business credit to qualify for loans. So what we do whenever I have a coaching customer, the first thing I'm going to do is I'm going to look at to see what is your fundability. Do you have business credit? And then we're going to pull those business credit reports and we're going to take a look and see what's on those business credit reports. And that's going to give us a really good indication of exactly what loans you can qualify for and what high limit accounts you can get quickly. And then you don't need a personal guarantee or credit check because again, we're looking at the business credit reports and the business EIN, and we're looking to see exactly where they're at. Now, they're always going to they've passed some money laundering standards where they need to identify the person that's actually applying for that loan on the business behalf. So they are going to probably ask you for your Social Security, but you can always look. And if you're in doubt before filling out an application, call the company first and ask them, does this report to my business credit report? Whenever you're doing a new credit for your company, make sure it's going to report to the business credit reporting agencies. So that's the first question that you're going to want to ask them. And second thing is make sure that they're doing this without a personal guarantee. If they do it without the personal guarantee, then it will not show up on your personal credit. It will only show up on the business credit. So you could have $2 million in business credit and it doesn't affect your personal credit. And when you go to purchase a home or to get a car, as long as you have both of your business expenses and all that in your personal completely separate. And if you don't or you need some more information on that, just get a hold of us. We have several different ebooks we can send you and we'll be happy to help you with that as well. SBA startup loans. You usually need to show some time in business for these. You can also show that you've been in that line of work. Like let's say, for instance, you've been running a business and you were the general manager of a location, and now you've decided to purchase that location. Well, in that case, they can take the time that you've been running that entity as the general manager in effect in this. But they're going to want to see that you have history running that business, or you have somebody coming in that has a very strong resume that can run that business and has experience in doing that business. The SBA is going to really want to take a look at that. And the SBA loan for working capital is a 7A. You can get approved up to $750,000. The thing that people love so much about SBA loans is the rates are super low, 2 to 4% above prime rate. All owners with 20% of ownership or more must provide a personal guarantee. So if you're looking for an SBA loan and you don't want to do a personal guarantee, an SBA loan would not be for you, because everybody that does a personal guarantee, when you do a personal guarantee, then it's probably going to affect your personal credit as well, because it'll probably report on both your personal level and your business level. And you also need good consumer credit. So just think of an SBA like you're going to get a government mortgage loan. And if you think of a regular mortgage loan, they want you to have around a 680. They want you to be able to prove your income for the last 2 years. They're going to want to look at your financial statements. They're going to want to look at all those kinds of things. And so as long as all those are all in line, SBA is definitely the way for you to go. Some startups don't have that yet. So it's better to start out with some of the other types of loans, like getting an equipment loan and getting a loan to get signs and a loan to, in different ways that you can get the funding for the different avenues that you want. But good consumer credit is required, and low documentation programs now with the SBA are available. So there is some new programs that do have, it's a so much more streamlined loan, and the SBA Express is far faster. You don't get as much, but you can get up to $250,000, up to 250,000. Rates are usually 2 to 4% above prime. Also is Community Express. If you have a low and moderate income, if you're in a low and moderate income area, Community Express might be something good for you if you're in one of those areas. There's also the SBA 504 loan, which is usually when you're going to buy your real estate or something like that. It's their second most popular, and it's used to purchase land, equipment, or real estate. So just think a major purchase. And so the SBA generally guarantees up to 40%. So the bank would fund the loan, and then the SBA would guarantee up to 40% of the loan. And you can usually get a loan of up to $1 million. So say, for instance, instead of going and leasing that office space, you might say, you know what, I want to buy the office space, and then I'm going to lease the other offices back to the different people. You could then come in with an SBA 504 loan and get this done fairly quickly. And it's just a great way to do it. And you usually have to put down about 10%, which is much better than normal commercial loans, because normal to buy a building, you need about 20 to 30% down payment, where with SBA, it's only 10%. So that's one of the really great programs for the SBA. Their microloan program has loans up to $35,000. Now, these are for the smaller ones. Those other ones, those first two are first one's for working capital, second one for buying land, equipment, things like this. Now, this is for working capital and growth, and they call this their microloan program, and they're up to $35,000. Average loan amounts are up to $10,000. The funds come directly from the SBA. And this is unlike the 7A, where the funds come from the bank. And so this is another one for you too. And then you can get private equity lines of credit, often $250,000, $500,000, $1 million, 8%. Usually they want to see with 20% liquid capital. You can use funds from other fundings. So if you have other fundings that are coming in, you can use those funds as well. Usually you have to have around 600 credit score, in the mid 600 credit scores. You must produce your tax returns for the last couple years, and that's everybody that owns 20% or more of the corporation is going to have to provide those tax returns. And then the house reseller, now if somebody wants to refinance your home and you say, you know what, I want to do this, or, oh, I'm sorry, no, this one's for fix and flip. So say you're going to go out and you're going to buy a house and you're going to buy it, fix it up and flip it. They're going to, you need a 660. You need experience doing it. I think at least 2 homes, I think is what it was last time I checked. But check with the loan officer. You have to have cash on hand to put into escrow, and you can get up to 65% of after repaired value. And it's an 8% rate or a 6-month term. So if you look at what the value is going to be after you do all the upgrades and whatever you're going to do, what that value is, they'll do 65% of that. So say, for instance, you're buying a house and it's for $70,000, or let's just say it sold for $100,000, you can get up to $65,000 or $65 if it was $100, and we're just doing that, make it real simple. But 65% of the after repair value. So say, for instance, then you're going to get, another 100,000 when you sell the house. It's going to be 200,000. So now they will advance 65% of the 200,000 that it will be worth after you fix it up. So this is excellent for an investor that wants to go and do a bunch of fix and flips and do it really quick. And we will definitely work with you. Book of financing, people that get commissions, any kind of recurring commissions can serve as collateral. And usually 2 to 3 times the annual renewal commissions. And this is normally where you have insurance agents that have renewing insurance policies every year. They come in and they do it. And this is usually a long-term loan. Federal grants, like scholarships for schools, grants generally do not have to be paid back. The federal government wants to give you money. And now they have a really cool website. I think it's grants.gov. And now you can sign up and they'll send you a link every time a certain kind of grant gets available for you. You also have the USDA, and you have the funding opportunity, small business innovation research phase 1. Again, but if you go to grants.gov, put in what you're looking for, it will send you all these different types of grants that will that you'll have to fill out. But just remember, there's going to be a lot of paperwork, and you may want to get a grant writer to come in and help you. But just give us a call, shoot us a email, and I'll be happy to help put you in the right direction and show you how the government now makes it super easy for you to find out about all the grants. They even give you an example of a completed grant. So if you want to do it yourself, you can do that as well. And so in your startup's your dream, but it needs money. And so I just wanted to thank everybody today for coming in and spending your lunch hour with us. I hope that gave you some good ideas that might have jogged your mind about some different ideas. Go ahead and email me at info@alexabusinesscoach.com. We're more than happy to help you with any questions. We also have a free 4-step guide on our website, which is alexabusinesscoach.com, that you can download for absolutely free. But our goal is to try to help as many business owners as we possibly can become as successful as they want to be. Thank you so much, and may God bless, and may your business prosper.